this is I'm going to provide you with a solution for the problem that were provided to you for the break-even. This was the Max Inc. Store where they were making tables. Make it tables. Okay. So the problem was that Max Inc. produces furniture. They have only one product, tables. They have 1,000 square feet, and they have some cost to operate the factory. And the information provided to us was per square foot per month. Per square foot per month. They're paying $20 rent per month per square foot, utilities $10 per square foot per month, and the parking and facility maintained was again $5 per square foot per month. So that would mean in order to know the annual cost, you would take $20 multiplied by 12 to get per year, then per square foot, and there are 1,000 square feet. So your cost will be $20 times 12, which is there are 12 months, and then you multiply by the number of square feet you are using, which is 1,000. Do the same thing with the other ones. And there is some variable cost to produce the tables. Lumber is $100 per table, which means that if you are making one table, it will cost you $100. If you're making 10 tables, it will cost you 100 times 10, just $1,000, and so on. Your nails and other material, the glue, the stain, the paint, about $20 per table. This is per table. Again, for one table, $20. For 10 table would be $2,000, and $200, and so on. In order to assemble the table, it takes about 10 hours per table, and we are paying $15 per hour to the labor to do the assembly. There are some fixed costs. Let's assume the depreciation is $100,000 and assume it's going to stay the same. In addition, there are people to manage the place. One supervisor, his salary is $50,000. One accountant, her salary is $60,000. Two sales associates, each making $45,000 each. And the baseline data is that in 2011 they sold 5,000 tables, and they charged, the price was $450 each. They have a bank loan where the interest-only loan and the principal is $500, and they're paying 5% on it. The average tax rate is 25%, and assume the material and labor cost is variable, and the rest of the cost is fixed. So depreciation, the cost of supervisor, accountant, sales associates, and the interest is going to be fixed. Okay, so on the right is what I am showing you the solution. Okay, but let's look at the input assumption. Typically, what I like to do, especially if it is an assignment for the first time, I like to lay out on the Excel spreadsheet. And again, I'm giving you the screenshot, so this way, if you did not get it right, you can go back and look at your solution in the Excel and make the adjustments based on the comments I'm going to make. So now you have the answers, and now you have to go in and update your Excel spreadsheet to be able to duplicate the answers. So the quantity we said was 5,000. Price we said was $450. Factory size is 1,000. Rent per month is $20. Again, this is all the information that were provided to us. I'm just putting it on the left side. Typically, it allows me to kind of keep the input assumptions on one side, and then I can use the Excel spreadsheet on the right side to be able to do the calculation. So the way my Excel spreadsheet would go is that I would take quantity, which is 5,000, multiplied by the price, which is $450, and that would be this number right here. So the formula in the Excel will be that we take the sales times the quantity and the price, we get that number. Now, as far as the lumber cost is $100 per piece times the quantity. So this thing over here in the Excel spreadsheet should be whatever your sell is for the lumber unit cost times the quantity, which is 5,000. If you take this times this sell, you'll get this number right here. Okay. Supplies. Supplies is $20 per table, which is right here in your cell. You take that times the quantity, and you will get this number over here. Labor is going to be done in two steps. One step is going to be that we know it takes 10 hours to make each table. And we also know that the cost per labor is $15 per hour. So first thing you want to do is to take $10 hours, multiply by 15. So that will give you $150 of labor cost per table. Again, how do we do that? It takes 10 hours and we pay $15 per hour. So 10 times 15 is $150. But because you're making 5,000 tables, we got to multiply that by 5,000. So here your formula should be, in your Excel spreadsheet, should be number of hours it takes, which is this. Your cell where you have cost per labor, which is $15 per hour you're paying them, times how many you're making, which is that number, and you'll get that number right here. Once we have your lumber, supplies, and labor, these are your variable costs, you basically, I subtotal to see what it looks like. So this cell over here in your Excel spreadsheet would be these three basically added together. You're going to add the lumber, the supplies, and the labor. Now to get the gross profit is basically how much money is left over after we have spent our money on the cost of goods sold. So that would be your revenue, and you subtract your variable cost of the cost of goods sold, and now you're left with this 900,000. So this formula would be your sales cell minus your variable cost cell, and you would get that number. Depreciation is 100,000 that was given to us. Now, in order to get the operating expenses, we have the rent, utilities, and facility. And again, the way we do it is we look at the cell where we have square feet, 1,000 square feet, times rent per month is 20, and because it is per month, times 12. So this thing over here, your rent will be, your rent's calculation in this cell will come from factory size times cell where you have the rent per month times 12, because it is 12 months in a year. We do the same thing for the utilities and same thing for the parking facility, and that's how you would get the cost that is tied in with the factory size and the rent per month, the utility per month, and the facility per month. Okay. Once you have done that, we just subtotal it to see how it looks for a total facility cost, which is really these three cells added up over here. Then we look at the other costs. We have a supervisor, 50,000. We have accountant, 60,000. We have two sales associate. This is going to be 45,000 too, and you get the sales associated because there are two of them at 45,000 each. You get 90,000. Then we add them up to see how these salary costs look like, which is going to be the sum of this, and this, and we add it up over here. So this cell should say this cell plus this cell plus this cell. Now to see where we are as far as before we start to pay our interest and taxes, what does it look like for earnings before interest and taxes? We are going to see how much did we have left over after we paid for the variable cost, which was 900,000, from which we will subtract our facility related cost, which was 420. We'll subtract the depreciation also, which was 100,000. We'd also subtract the salary cost, which is 200,000, and so now we're left with 180. So this thing over here, this cell, should basically take your gross margin cell, subtract depreciation cell, subtract facility related cost cell, and subtract your total salary cell, and you should be left with $180,000. Then we have the interest expense of 25,000, so we plug that in. Now we see how much we have left before we pay taxes, or earnings before taxes, which is EBT, and that is basically this cell will be what we had over here. Now we subtract the interest from it, and we are left off with this number. Then we pay taxes. Our assumption is the tax rate is going to be 25%, so we basically take our earnings before taxes, multiply that by 0.25, and so this cell basically will be your cell where you have earnings before taxes right here, and you're going to go to the cell, multiply it with the tax rate, and you should get that number. Now the net income is going to be what you got left after you paid your taxes, so this cell will be earnings before taxes minus taxes, you get that number. Return on sales is going to be net income we are making per dollar of sales, which is going to be this number over here. So your return on sales is going to be, I'll write it down, is net income divided by sales. Okay. And typically you want to put this in a percent. I forgot to do that. This should be 0.0516, which basically is 5.16% return on sales. Now, in order to break even, we want to do is to look at a fixed cost and variable cost. Like I said, the assumptions I gave you was assume that everything except for the cost of goods sold is a fixed cost. So here is your variable cost, which we're basically pulling it from up here, which is the cost of goods sold, and everything else over here, we add them up. We took all our costs, including our depreciation, including our facility related, including our salary, including our interest. We add them up, and we get $745,000. Okay, and so total cost, that would include a variable cost and a fixed cost, and fixed costs are, as described before. In this example, it will be the depreciation, the facility related, the salary, and the interest. And so if I add both the variable and the fixed cost, I will get this information. So this is nice, handy information to have. So we can see over here that for our business, about 64% of a cost is 64.4% of a cost is variable, and the rest is fixed. Okay. Now, to do the break-even calculation, the formula, as we had talked about in the earlier presentations, is the break-even quantity is looking at our fixed cost that we have and dividing it by the difference between the price per piece and the variable cost per piece, and that's how you do it. Now, a variable cost obviously is $270. How do we do that? We basically take our total variable cost, which is 135, divided by the total quantity, which was 5,000. So our average variable cost is 270. And if you do the calculation, what we take the fixed cost, which is 745,000, and divided by this information, we'll get that number. So you're in the Excel. This thing right here should be a formula where you're taking this cell, dividing it by parentheses, price, which was 450 from up here someplace, minus the variable cost, and that's what you should get. On the other hand, if you want to know is how much lower can I lower the price before I will, be break even, which means no profit, no loss. The calculation is you take a total cost and divide it by the quantity. So we take the total cost, divide by the quantity, you'll get this information. So what is this telling us? What this is telling us is for assumptions we have for this business, the business should sell at least 4139 units if they're going to sell it for 450. Anything above that, they will make profit. Anything below that, they will lose money. On the other hand, if they want to see to say, okay, I am making 5,000. I would like to sell all 5,000. What is the lowest price I can go before I am going to either not make any money or not lose any money, which is your break-even price. So in that case, the quantity is 5,000, and we see how much total cost we have. And if you do that, that basically means that you need at least 419 units to sell. So I'll summarize this before I go to the part B. So the part A was that we have assumptions that were given to us about the business, and from there we had to figure out the income statement, and the income statement basically is your sales, your cost of goods sold. In this case, there are three pieces to the cost of goods sold: the lumber, the supplies, and the labor. We calculate that, and then we start to look at our fixed cost, the depreciation, the operating expenses, salaries. Then we get to the earnings before interest and taxes. We get the interest, earnings before taxes, net income, so on. Then we get the variable cost, which is your cost of goods sold. Fixed cost is all our costs, including depreciation, interest. And our goal is to say, at what quantity will this earnings before interest and tax will be zero? And the formula is that you take your quantity divided, in order to calculate the quantity, take your fixed cost, which is in this case is this number. Where did that come from? We basically added up all the numbers in a cell right here that are fixed related. What does that include? It includes your depreciation, it includes your facility costs, includes your salaries, and includes your interest. You get 745. Total cost is nothing more than adding these two up. The unit variable cost is going to be how much does it take to make each table, which is your lumber, your labor, and your supplies. Easiest way to do that would be to take your total variable cost divided by the quantity, and you get that number. Then you do the formula and you get these numbers. So that was part A. Okay. Part B. Part B was included another element, and then say, what if we had to do some forecasting? And the forecasting part comes in that what if we are looking at our business and we did a market analysis, and what if we said, what if we can lower the price by some amount, and if we lower the price, people will buy more tables, basically putting stuff on sale. So assumption is that what if they lower their price by say 7%, and they will allow them to increase the quantity by 10%. Now, that's the assumption the marketing people have done, either based on prior history or based on the analysis they have done. So those are the assumptions they have made. So our job is to create the income statement again, and assumptions are, again, quantity will go up 10%, but the price will go down 7%. And we're going to account for next, we're doing this for next year, so we're going to assume that salary, labor, all the cost related stuff will grow by 3%, so the inflation. Assume that there is no change in the rent and facility related costs because maybe we have a long-term lease agreement. Utilities, again, will grow 3%, and there is no change in the interest and depreciation. So our job is to calculate the income statement and also the break-even quantity and make some comments. So again, here, typically, again, I like to do the same thing. I like to do is to be able to put the input assumptions over here and then use the calculation on the right in the Excel file. Now, so what is the difference here? We have to start including the assumptions that are provided for the forecast. So let's say if you're looking at the sales. So there are a couple of ways to do it. You can go in and I'll just move this down. This quantity, should be on the next page, but just right now I cannot change it because I'm recording. But anyway, so if I look at the quantity, I'm growing it by 10%. So I want to do is to use the formula to calculate the quantity. So this cell over here in Excel would basically take the original quantity of 5,000 and then grow it by 10%. How would I do that? I would take 5,000, multiply by 1 plus R, which is 10%, and I would get that number. For the price, I'm reducing by 7%, so it's minus 7. Obviously, so I calculate the price to be lower, so it would be 14.185 instead of 14.50. 7% less would be $1,418.50. So the marketing logic in this exercise is that if they can sell more, but at a lower price, what is going to happen? Now, in order to calculate the income statement, we have to start figuring out the sales, cost, and so on. So sales, again, will be the quantity. So we need a new quantity, which is this number over here, times the new price, which is this number over here. So basically, revenue or sales is always quantity times price, but we have to use the new quantity and the new price. So whatever your sales are, you're going to put the formula so you get that number. The lumber will also grow. Why? For two reasons. One, there is inflation. And two, the quantity is changing. So what you're going to do is you're going to take your lumber cost, which is 100. You're going to increase it by inflation, which is 3%. So 100 will become 103. So your formula over here will be 100 times inflation, so times 1 plus 0.3, so that would be the cell right here. You're going to multiply it by. And from there, you are going to also account for new quantity. Remember, if you're going to make more tables, you will need more costs. You're going to use the new quantity, which is the cell over there. So if you do that calculation, we'll get that number. So the point I want to make over here, the reason I made these notes over here is that for sales, you are accounting for new quantity and new price. For cost, you're accounting for new quantity and the inflation. Same thing with the supplies and the labor, new quantity and inflation. Depreciation doesn't change. Assumption for the rent worth, it will not change. Utilities is growing by inflation, so you have to grow this by 3%. So you're going to apply that cell 1 plus over here and do this calculation. Facility related cost assumption is no change. We add them up. Supervisor, accounting, salespeople. Again, assumption is they're going to get paid 3% more, so we're going to grow there by 3%. we add them up just like we did in the part A. You got the EBIT, you got the interest, no change, NC basically no change in our assumptions, and so on. And we go through it, and now we're gonna see, we do the calculation, and we'll get the break-even quantity that we'll have to sell 530.75 to be able to break even, or the lowest we can go is 415. Okay, now so this basically said that based on these assumptions, we would have to sell 53.75 to break even. What we did the first time around, we needed break even to be less. And I think you want to kind of think that through, because this is the value of the analysis. And the reason is depending upon what combination of price growth versus quantity growth you assume, that will have an effect on how you're running the business. So now exercise that we are trying to make you do is to understand A, break even, and also understand forecasting. So this exercise was really designed to be able to teach you that. So again, part 2, assumptions were that we are going to forecast for next year, which is right next year, salary of people, accounting, so on, all labor costs, supply should grow at 3%, no change in rent and facility related costs, utility costs at 3%, no change in depreciation. We went through it and did the forecast. And the nuance is that we need the new quantity, which is 10% higher. We need the new price, which is 7% lower. And then we calculate the sales, which is the new quantity times new price. Lumber is going to be new quantity. Obviously, more tables we make, more lumber we'll have to buy, and the cost is higher by inflation. Same thing right here. Depreciation, no change, so on. And we get the net income. And then from there, we can figure out the break-even just like we did with the other one. So hopefully this was helpful. And again, your job is to be able to replicate this on your Excel spreadsheet. And this way, at least you'll understand 2 things: how to use Excel spreadsheet to do forecast, and also how to do break-even using the assumptions.